Hello and welcome to Price Target Research. I'm John Lafferty. Our research briefs are short discussions of investment and research topics, including our current rating on stocks of interest, key analytical questions and techniques, and important alerts and events. So let's get started. In this research brief, we're going to discuss how changing investor expectations can have a significant impact either positively or negatively on stock price, and look at some of the tools we use for assessing these kinds of changes. First, some definitions and examples. In this case, the black line represents a company's monthly stock price, closing prices for the month. The black dot is reported earnings per share on a trailing four-quarter basis. So each black dot represents the company's earnings per share over the prior four fiscal quarters. The circle with the zero in it reflects consensus estimates for this company for their fiscal year 2010, as you can see. They're plotted monthly as received, and you'll see in this case that over that period, the estimates rose from $1.20 a share to $2.10 a share, a pretty big increase. That's not earnings growth, that's a change in expected results, so a very large increase. And finally, the black dot is what the company actually reported at the end of the period. It had a fiscal 2010 September 30 year, and you can see the actual reports. Let's look at a couple of company examples and how expectations affected stock price. Abbott Labs is a Chicago-based company, a classic quality growth stock. Over 10 years, the stock compounded at 18% a year. It was highly profitable, regular dividend increases, huge returns on capital. What could be better? In fact, analysts sometimes would call a company like this a ruler stock because the earnings are so consistent that you could literally put a ruler on the earnings, extrapolate the line, and you too could be a securities analyst. But wait, the colored circles here, as you recall, represent earnings expectations. These are each year the same situation with the number relating to the company's fiscal year. And let's pick a couple of them out and look at how consistently Abbott's earnings were estimated. You can see, for instance, for fiscal 1992, that the first set of estimates we got essentially was unchanged for the whole period, and the company basically reported estimates or earnings right in line with estimates. The same thing for fiscal 1996. Remarkable stability, little variation in estimates over 2 to 3 years, estimates exceedingly accurate. What's the consequence for that? Well, what's interesting here is that Abbott, as good as it was with an 18% a year gain in stock price, only afforded, the light line here is the price relative to the S&P, and the interpretation is that Abbott really only afforded a return in line with the market. It was a raging bull market for most of the 90s, and Abbott essentially performed in line. Superior business performance in this case was already in the stock price. Let's look at a more recent example. Apple, a 100-fold increase in stock price over the period, 9,900% return. A massive increase in estimates occurred during the period. Significant increases in estimates and expectations literally for a decade. For 2005, for instance, estimates rose 470% between the first estimate back there in 2003 in the company's report. So almost a 5-fold increase in estimates for the company. If you look at fiscal 2010, there was a 160% increase in expectations. And for fiscal 2011, a 340% increase in expectations. This works the other way. Oceaneering International is an oil well drilling equipment company which had a number of really good years, but starting, as you can see, in 2014, the stock price began to decline as fracking caught up with oil prices, and their oil well drilling equipment, as prices fell, had to be mothballed because customers didn't need the same level of drilling activity. So you can see here that for the three fiscal years 2015, 16, and 17, very substantial reductions in earnings expectations, followed by a 70% decline in stock price. So in summary, highly predictable companies rarely generate superior investment returns. Predictable performance, no matter how superior, is oftentimes already in the price. Outsized returns in either direction come when a company's business performance deviates significantly from the consensus view. And finally, to be a successful investor, you have to understand current investor expectations. Well, that's it for this research brief. Until next time, you can find more of our videos on YouTube/Price Target Research, or you can visit us on the web at pricetargetresearch.com, where you'll find very broad coverage, comprehensive research and ratings, and relentless updates and alerts. See you on the next research brief.